Good evening. This is Mike Murphy with CattleFax, and I'd like to welcome you to the CattleFax Trends Plus webinar. If you can hear me, you'll be able to see a spot there on your screen that there's a little hand showing, and if you just touch on that hand, it should be able to show up on our screen to note that you can hear me. And I see a few of those hands popping up, so I believe that we're in good shape for you to be able to hear the webinar today. We appreciate you taking time out of your schedules to spend a little time with us and go over some information. What we've got scheduled in here for today's presentation is that we want to start off talking about new crop grain and forage production in terms of where we are relative to the corn market. We want to talk some about what we've got going on relative to fundamentals and shaping the market for the calf and feeder cattle market in here between now and the end of the year, and really looking into next year as we think about some of the stocker operations as they start to try to procure some calves for 2014's marketing window. Talk some about herd expansion, and then we're going to talk about just more profit opportunities for the winter and stocker backgrounding operations. We're fortunate to have Ryan Dunn, who's the marketing manager for U.S. Cattle Biologicals with Zoetis, to be with us today. And Zoetis has been kind enough to be our sponsor for this program. So we really appreciate all the assistance that Zoetis has provided CattleFax over time. And so I'm going to let Ryan talk about some of their new products that they've just launched in here recently. And so Ryan, I'll turn it over to you.
Great, thanks, Mike. And we'll advance the slide, and I appreciate the opportunity here to speak with everyone. As Mike mentioned, the relationship with Zoetis, which was formerly Pfizer Animal Health and CattleFax, is one that our company is very proud of, and we appreciate the opportunity to speak with you all. At Zoetis, our big news this fall is the introduction of a new vaccine offering called Bovishield Gold One-Shot. Bovishield Gold One-Shot is a new vaccine that we've developed here at Zoetis that combines two of our existing vaccines, Bovishield Gold 5 and One-Shot. So the new vaccine is called Bovishield Gold One-Shot, and it's a combination vaccine that features components of the two #1 viral respiratory vaccines and #1 Mannheimia hemolytica bacterium vaccines in one convenient dose. When you consider Bovishield Gold 5 as a vaccine separate from One-Shot as a vaccine, which many of you on the call are likely familiar with, this new vaccine, Bovishield Gold One-Shot, maintains the exact same levels of respiratory protection as afforded by each of the individual parts. So on the next slide, we'll speak a little bit about the product profile of Bovishield Gold One-Shot. Bovishield Gold One-Shot provides viral respiratory and Mannheimia hemolytica protection. It's got duration of immunity claims that are unique in the combination vaccine space. Bovishield Gold One-Shot helps provide protection for 279 days against the pathogens IBR and BVD type 1 and type 2. Bovishield Gold One-Shot is a vaccine that helps prevent respiratory disease that can plague cattle, as this group's well aware, throughout the year as far as respiratory disease that can result in significant losses to your operation. So with Bovishield Gold One-Shot, this is a vaccine that our customers have asked us for over the years, and we're pleased to announce this fall that it'll be available for you folks to use on your operations. The next slide describes in a bit more detail what we mean by upgraded respiratory protection. So if we consider the features of Bovishield Gold One-Shot compared to other combination vaccines in the marketplace, you can consider things such as, and I believe if we advance the slide one more, we've got superior IBR, BVD type 1 and type 2 respiratory disease duration of immunity claims compared to other competitive combination products on the market. The dose administration for Bova Shield Gold One Shot is a 2 milliliter dose administered subcutaneously in the neck region. And our new Bova Shield Gold One Shot product is available in 5, 10, and 50 dose vial sizes. So the marketing campaign that I'm in charge of that's going to introduce this new vaccine offering is on the next slide. We'll advance here and show you what the image looks like, but the way we're positioning this product is it represents an opportunity to upgrade respiratory protection if you're using an existing combination vaccine. So I appreciate the time. We wanted to keep it short here on the webinar introducing our new product. My role was to help work with our cattle technical service teams, our research and development team to bring the product to market, and we hope you'll give it a try this fall. Many on the call have a relationship with a Zoetis cattle technical services representative or a Zoetis territory business manager. So if you have questions on our new vaccine, feel free to reach out to your local Zoetis sales rep or cattle tech services rep. So at this point, I'm going to hand the discussion off to Chad Spearman.
Good evening. This is Chad Spearman with CattleFax. First off, I'm going to take a look at summer weather conditions and expectations for the corn and hay markets as we go towards the fall and into next spring, and the impact, obviously, that it has on from a cost of gain perspective back down to the feeder cattle and calf markets. As we look back into the late spring and early summer, drought conditions held a grip on the central and western U.S. However, we had above normal soil moisture conditions across the Midwest and the Southeast at that time. For perspective, nearly 25% of the beef cow herd resides in the southeastern states, and more than 25% resides in the southern plains alone. As we move forward towards the late August time frame, we ended up having moisture throughout July and August that actually lessened the drought severity across portions of the central and western U.S. However, a lack of moisture allowed short-term drought conditions to expand into the Corn Belt and portions of the Southeast as well. Initially, the cool, wet conditions that slowed corn planting progress this spring. In fact, we had only 46% of the crop planted by May 15th, which was the slowest pace since 1995. But despite the slow start, crop conditions remained better than average prior to the recent declines that we've seen in the last few weeks. As of August 25th, only 23% of the crop was dented across the U.S. Crop maturity continues to lag, which elevates freeze risk going into the fall time frame. But with that, still feel like we have very solid corn production potential here in the U.S. Assuming no major freeze damage does occur, U.S. corn production potential ranges from 13.7 to 14.1 billion bushels, which if realized would be record large. The USDA's August forecast for the crop was at 13.8 billion bushels, and usage is also expected to rise substantially. Significant increases in corn supplies and significant increases in corn usage. For the new crop marketing year, which began on September 1st of this month, it runs through August 31st of 2014. Total U.S. corn usage is expected to rebound significantly compared to last year, which was as a result of the drought and record high corn prices and the need to ration corn usage. However, the increases in corn supply are expected to exceed the increase in corn usage, driving ending corn stocks higher than where they've been in recent years. Ending stocks divided by total corn usage from the USDA provides the best supply versus demand measurement. For the first time since the 2009 and 10 marketing year, stocks to use levels are expected to rise above the 12% mark, and prices are inversely correlated to stocks to use, and lower prices are expected to be realized going into this fall and spring of next year as well. stocks to use levels are expected to range from 13.5% to 15.5% into the spring of 2014. As you can see, last year, the final stocks to use ratio is estimated at 6.4%, which is a significant decline compared to historical levels. The only year where we had a tighter stocks to use level was back in the 1995 and 1996 marketing year. So with that, as we take a look at corn futures expectations, again, we've come off the high from a year ago when spot corn prices were up on top of $8 and have trended significantly lower. But based on the fundamental expectations, we would look for spot corn futures between now and the spring to find solid support in around $4.40 to $4.50 a bushel, and significant resistance around $5.40 to $5.60 per bushel. Taking that one step further in here, we'll expect to realize those cheaper corn costs and cheaper cost of gains in the feed yard, but also cheaper forage prices in the longer run. As we sit in here today, U.S. alfalfa prices are largely from $20 to $40 a ton cheaper than a year ago. They have cheapened up some, but not nearly as significantly as corn prices have. And historically, there's also a lag going back to alfalfa prices relative to corn prices. Again, we come with the drought last year, a significant decline in hay stocks for other hay and alfalfa both, but we would expect to see significantly cheaper forage prices, but basis alfalfa may end up taking further on into the spring of 2014 before that's actually realized. With that, I'm going to hand it over to Mike Murphy.
Thanks, Chad. Appreciate it. We're going to shift gears and talk a little bit as we look at some of the data here in terms of where we are from an inventory perspective. And then we're going to look at more of an outlook as we start looking at calves and yearlings from now going into next spring. And then kind of summarize things relative to the annual forecast for 2014. Mother Nature has been a real devastation to the industry in here over the course of the last couple of years, and we've seen continued liquidation as you start looking at the beef cow sector. Beef cow slaughter year-to-date is running up about 1%, 1.2%. As we look forward into the end of the year, and you can see that on the chart here when you look at 2013 relative to last year, you know, we were seeing just in the last few weeks those year-to-year declines in terms of beef cow slaughter. And we expect that to continue for the remainder of the year, with the greatest declines coming out there towards that fourth quarter time frame. The importance of this is that because of the bigger cow slaughter in the first half of the year, we're still going to end this year in terms of a liquidation. When we start looking at our overall beef cow inventory, we'll touch base on that data here in a couple of minutes. I think most of you, as you look at your situation there out in the country, would acknowledge the fact that we have an opportunity to really start to stabilize the beef cow herd if Mother Nature would allow it. The economic incentive is there with where your calf values have been here in the last few years, but our feed costs have been high enough, as Chad alluded to, that we haven't had the economic incentive. And so we're looking for that to start to kind of change in here more for 2014 than we'd have in 2013. Another variable that we monitor very closely in terms of kind of stabilizing the cow herd or expansion, if you will, is looking at heifer slaughter as a percent of the fed slaughter. And this data here, as you look at it, looking at 2013 versus 2012 year to date, we're right on line in terms of about 36% of the total fed slaughter is heifers. And all that is just an indication of what we've all seen in the other data sets, is that we have been in liquidation over the course of the last couple of years. For this to drop back in here towards, say, 34, 35%, as you start looking at it from an annual average perspective, through the first half of the year, I should say, that would start to construct more of a stabilization to the cow herd, and seeing where the cow-calf producers are actually retaining some heifers back into the herd. We'll be watching this data very closely into the end of the year, but most importantly in the first quarter of 2014. If we're truly going to see some heifer retention, it would be on yearlings that would have been turned out for this summer. And if those aren't placed on feed this fall and not harvested there in the first part of next year, we'll see that in the data, and that'll be the first signs of starting to see some heifer retention. The next spot we'll start to really zone in on the data for heifer retention is looking out there towards next summer. With the cheaper feed grain that Chad alluded to earlier, we should have the opportunity to see more heifers actually placed on feed as calves this fall if we're going to go ahead and see that take place. And so they'll come out as marketings out of the slaughter side next late spring, summer, and so that'll be also another spot we're looking to see if there's any sort of retention. But when you roll this data up and we start looking at 2014 and you look at the data going back in here since the 1980 time frame, we have a beef cow inventory as of January 1 of 2014 to be down about 1%, which again is another liquidation year. And you can go back and look at where we've been in here. Since really 2006 and 7, we've had a significant decline in terms of our beef cow inventory. Through that period, we've weathered some storms, though. You think about the Great Recession that we experienced there in 2008, its influence on calf values, but we've had a recovery to the market in terms of the calf market over the course of 2010 and in here to 2013. That recovery really supports the fact that we should have seen some expansion taking place. Again, Mother Nature has not cooperated, as you all are well aware of. So we believe that if we start to see a little bit better response out of Mother Nature, get a little bit more moisture back into the country, we'll start to see this herd stabilize as we look in towards 2015. And that's really when you look at the data here. Next year, we would expect to see a slight growth to the beef cow number. Some of that's going to be on the heifer side. Some of that will just be keeping those cows kind of one more year, if you will. But again, overall, we feel pretty good that if the economic signal is clear to us, we just need to have Mother Nature respond and show us some more green grass, and we'll start to stabilize the herd. As we shift gears a little bit and start looking at our outlook to the calf and feeder cattle market into the remainder of this year and on into 2014, I think it's real important for everybody that's in that segment of the business to understand one of the keys of the value of feeder cattle and calves. And that is that we're dealing with a excess feeding capacity, and in a lot of senses, we've had a excess fed slaughter capacity as well. And as you start to look at this data, you go back in here, going way back into the first part of this last decade, you can see what we've done with the feedlot capacity. It's basically sustained this level of right around 33 million head of cattle. You look at the slaughter capacity, and you went for a period of time in there in the first part of this decade where it was fairly stable. You have the closing of the Emporia Tyson plant, so you started to shutter a little capacity then stabilized a little bit. And then obviously we had the closing of the Plainview, Texas plant of Cargill's here this year. The thing that stands out, though, is looking at this relationship with this feedlot capacity and how that's correlated with the decline in beef cow inventory. So you know you have fewer calves to be able to be placed on feed as we look at the decline in beef cow inventory, but the feedlot capacity has sustained itself. Well, what does that mean in terms of the value of feeder cattle and calves? A lot of you understand this as you look at the business. The cattle feeding business is about occupancy, and maintaining occupancy can result into some solid returns operationally for those businesses. But you also got to take into consideration whether or not the cattle themselves are making or losing money. But what we've tended to do is you look at this chart here over the course of the last several years, we've tended to go out there and kind of what we call bet on the come. And for those that are CattleFax members, you've seen that terminology used a lot within the CattleFax update. And what we mean on that is that we're willing as a cattle feeding sector to go buy a break even that is not hedgeable at a profit the day we buy those cattle. The net result of that is that we tend to lose money. And you can really see that. This is going back since 2008. We've had significant feedlot losses there in 2008 through the Great Recession. We had a good recovery into 2010 in the first half of 11. And then since then, we've been in an equity drain that has continued in here to the late summer of 2013. But if you think about it relative to the value of feeder cattle and calves, those values have actually sustained themselves pretty darn well. And the first one that we're going to look at here is looking at a 550-pound steer calf. This is looking at a little different in terms of your calendar. We're starting this as of September 1 and going through August 31st. The black line is on this right axis, and that's just the value of calves. And you can see through this last 12 months how high calf prices have been. Now keep in mind, as we looked at the corn data earlier, we spent a lot of time with corn values somewhere between $7 and $8 a bushel through this whole period. But you had pretty sustained calf values through this entire time frame. The same would be applied as we look at it from a feeder cattle perspective. Again, right axis is the value of feeder cattle. Early on last fall into the early winter, a lot of the feeder cattle trading, and this is looking at a 750-pound feeder steer price at $1.40. We got down into the low 130s this spring, and then we've had a significant rally to those cattle here in the last couple of months. And this has been a part of the fact that the cattle feeding industry has been willing to step out there and take some risk on buying feeder cattle. If we were seeing that industry actually own the cattle at a profit the day we bought them, we would have seen calf values 5 to 7, in some cases $10 a hundredweight lower than what they were actually trading for. So this occupancy challenge is that the feeding industry is dealing with is actually a bonus for the calf and stocker feeder cattle market. And so as we think forward here and we start looking at now this marketing year here as of September 1 that we just started, you can see where we finished up when we look at our 550-pound steer price just on top of $1.70. You look at the blue line, which is the index, and typically you'd find those lows out there into this Octave time frame, and then the values would climb in there towards the spring when you think about the green grass fever, if you will. As we look at this market, we believe the market's going to be more flat, just as it was last year through the fall, with a slight tendency to improve and then really accelerate late year into the spring high as we look at the values. Next year, we're expecting to see calf values next spring trade on top of 210, 215 a hundredweight for a 550-pound steer when you look at the market. So a definite strong acceleration. Now, the one thing that we'll make note of there is that that's on the assumption that we've got good grass forecast for next summer in terms of grazing. But that would be the outlook as we look at the market in here going forward. And then next fall, things would pull back in here, and depending on the size of the corn crop, you would start looking at next fall values somewhere back in towards that, $1.75, $1.70 area, kind of at the lows. Again, that'll be heavily dictated on what the corn values are coming out of next summer's crop production. From a feeder cattle perspective, as you look at this right axis, we're finishing up this September 1 to August 31 marketing year, basically in the mid-150s. We feel like that we're going to base a lot in this feeder cattle market over the course of the next several weeks and actually months. As we look at the fed cattle market outlook, and the grain market outlook, as Chad alluded to earlier, we'll spend a lot of time somewhere in the low 50s to kind of low 60s from now until the end of the year for those feeder cattle values. As we move in towards the first quarter of next year, that'll be a spot that if this Fed market is improving and we're trading in that low 30s with expectations to get into the mid 30s next spring, then you'll have a chance to move this feeder cattle market back into the low 160s. But a lot of time to be spent, again, in this low 50s to kind of mid to upper 50s from now until the end of the year. As we shift gears a little bit and talk about utility cow price values, and again, you can see the seasonality here with the current marketing year that we're dealing with. One of the big assumptions that we have with the cull cow market going into the fall is that we've got a very, very small increase in non-fed slaughter from where we were this summer into the fourth quarter. And the net result of that, as you look at where the cull cow market's been trading in here through the summer, sometime there in that, or those levels of kind of the mid-70s to upper 70s, we think those levels will sustain themselves as we move into the fall time frame. You might have a few weeks there at the very fall low as you look at the index somewhere back in the low 70s, but we're going to spend a lot of time in the mid-70s to upper 70s. And then as you look at this seasonality, we're expecting the cull cow market to get back somewhere up there into the potentially the upper 90s for spring highs. Those would be absolute highs next spring. The key with that assumption is that we've got a significant decline in non-fed slaughter forecasted for that winter time frame. And so with that in mind, if for some reason Mother Nature plays a role that's a little bit more negative, that could certainly limit how much of a decline in the cow slaughter we'd have, and we would temper our optimism for this cull cow market. But right now, that's the expectation that we have in terms of the market. As we look at this data here, this is a heifers as a percent of U.S. feeder and calf sales. And what you're finding here just in the last few weeks as you start to look at some of the data is that potentially you're starting to see more of these heifers, which will be this spring's calf crop, retained back into the herd. And ultimately, those would be looking to be developed as beef replacement heifers going forward here. And that number would really show up into this 2013 and 2014 data, which we do believe we're going to have some expansion, as I said earlier, relative to the cow herd, and we'll see some of that show itself and express itself here on the replacement heifer side as well. So as we summarize things, looking at 2014 from a market perspective, we believe that the calf market on average is going to be about $1.85. Again, those highs could be as high as $2.15 this spring when we look at the market. As we look at the feeder cattle market for 2014, we're talking about right around $1.55. We'll spend a lot of time in the first half of the year somewhere in that kind of low 50s to low 60s. As we look into the second half of the year, you'll have a lot more opportunity, assuming that the grain market behaves itself, to spend some time in the low to mid 60s. Fed cattle, we're expecting to average just shy of 130. That should put highs somewhere there in the mid to upper 130s for the spring, going back into the low 20s for a summer low, and then going back, and we feel pretty confident outside of some sort of a recessionary period of going back into the upper 30s there in the fall of 2014. And then as we summarize things from a cow-calf perspective, the cull cow market averaging 84 to 5 next year. Again, the spring will be somewhere in that mid to upper 90s, and then fall lows somewhere back into the mid 70s as you look at the market. So with that, I'm going to turn over to Lance Zimmerman, and he's going to take you on to look at some of the margin information.
Well, thanks, Mike, and want to make sure I call out to everyone as we work towards the last 15 minutes or so of coordinated program to let everyone know that while we've muted everyone just to keep the background noise out of the discussion, everybody does have the ability to ask questions. You should see a question window on your chat pane. And I know we've gotten just a few questions that have already started to come in, and want to encourage you to continue sending your questions as you have them. We have monitors watching the question board. They'll be grabbing those questions, sifting out duplicates, and making sure that we have a chance to answer those towards the end of the program. So feel free to type those in. We'll be watching those and get those to everyone and try to address as many of those as possible before our hour is up. But as we look forward here, really my goal as we wrap things up is to take the information that both Mike and Chad have presented and really bring it down to your operations level and challenge everyone on the call to apply this information to exactly what they're doing. And I think the ultimate goal that all of us have as we look at our own operations is how can we maximize our returns. In this graph, you might look at the last few years and say, gosh, those returns sure seem a little bit high or maybe even a little bit low compared to my own operation or operations that I know of. And I'll just say that there's a lot of variability in these numbers. Obviously, regionality over the last 2 years due to the drought conditions and culling activity on a lot of operations alone has created a lot of variability, but even on a good year, there's a lot of variability depending on the size of the operation and how they're able to spread those costs over a larger number of cows versus a smaller number of cows, and even just the management intensity of a cow-calf operation can really cause those to fluctuate. But I think the important thing we need to focus on is, are you a high return producer in this market environment or a low return producer? And how do you move yourself forward? How do you make yourself the highest return producer you possibly can? And I think as we look at this, it's pretty clear that the cow-calf guy on average has had pretty good fortune over the last few years. Basically, the last few years we saw some significant or even questionable margin environment was in the late 1990s. And so overall, the cow-calf guy has weathered 20 relatively good years from a margin perspective. We're not going to even get into the discussion of Mother Nature. I think we all know how cruel that has been to some of our friends and colleagues that have had to work through that. But I think it also goes to bear that the cow-calf guy's been in the driver's seat as he has the supply that the industry above him is trying to capture and trying to basically take advantage of capacity that's been idled as we've reduced the cow herd numbers. And so as we go forward, really want our discussion to zero in on exactly what are those habits of the high return producer. And we won't be able to spend a lot of time on this in later slides simply because this is a longer term management decision. One of the biggest things you'll find with a high return producer is that term is exactly synonymous with the least cost producer. That guy that's out there getting the highest dollar at the sale barn may or may not necessarily be the high return producer. It's typically that guy that's taking advantage and watching his feed costs, utilizing crop residue, utilizing feed purchases during peak supply periods, taking the time to lessen his debt load or decrease operating expenses on a day-to-day basis. Those are the things you do to focus in on being that least cost producer. And year in, year out, whether it's CattleFax data, extension data, USDA data, what we tend to find is those producers that are the most profitable, that are those high return producers, are almost always the least cost producer. Now I say this with one caveat, and that is that the least cost producer isn't sacrificing production for the sake of costs, that they're also looking at what their productivity is. Not just sale weights, but also taking it the next steps farther and looking at what are their conception rates. When you think about a calf today, a 550-pound calf this fall will probably be bringing around $900 a head. And so for every live calf that you can make sure a cow weans successfully, that's added dollars in your pocket in a very significant manner compared to even just 5 or obviously 10 years ago. And then taking that even the next step and combining those two metrics and really focusing in on what are my pounds weaned per cow exposed. Once you do that, then the last step is always fine-tuning that management of your genetics, your overall health programs, and nutrition to make sure that while you're still fitting into that least cost model, you're doing the best you can within the resources available to you to produce efficiently, basically. The reason I mention all of this is because we've done a great job of it as an industry, especially over the last 4 or 5 years. This here is basically a graph that summarizes the value of production on a per head basis for the U.S. fed cattle population. And so it accounts for, just for background, it accounts for the fact that we've seen carcass weights increasing every year. It accounts for quality grade that's been improving each continuous year. And obviously we've been in an environment since 2002 where we've seen cutout values increasing, as well as the dollar value, just the base price that's being paid for cattle. And so as we look at this, from 2002 to 2008, we had an annual growth rate in the value of production of the fed cattle being produced of about 6% a year. And then since the recession, if you could have invested in stock that was fed cattle, you experienced a growth rate of 11% per year. Basically, we increased the value of what we're producing as an industry and its value to the packing segment or the wholesale segment, $600 a head over 4 years. And what this does is this has given us the opportunity as stocker operators, backgrounders, and cow-calf guys to get those higher prices, those record high prices that we have, because we've been able to increase the dollars available to go around between all of the supply segments. I mention all of this to simply get at, as we talk about value-added production and those premiums that come from it, it is fueled from this exact concept right here. The ability we have to grow an animal successfully that the consumer wants is adding more dollars into all of our pockets if we produce to those programs. And so one thing that we talk about often at CattleFax when we talk to cow-calf groups is the stair steps to profitability. And this is something we've had for a while and we continually update. I'll put your attention to the orange bar along the bottom, and I think it's important to mention that average cattle, commodity cattle with not a whole lot of added management to them, are going to bring the average price. Then those calves that are undermanaged, calves that have sold and the steers aren't castrated, aren't dehorned, are a commingled group of calves that haven't had any shots and might have been weaned the few hours before sale time as they were thrown on the trailer. Those are the undermanaged cattle, and those are the cattle that are receiving discounts in the marketplace. And in order to participate in those premium programs and capture those added dollars that we've created since 2002 on that earlier slide, we really need to focus on those management characteristics as you work up the chain. And we put them in order of both the premium that's available to the producer as well as what that implementation cost takes. Obviously, it takes an investment in facilities, in labor, and also capital to make these things happen, and we can fully appreciate that. But the market typically rewards the most for the most basic principles that also return the highest value to them. And time in and time out, we hear from order buyers, whether it's from the stocker segment or the feedlot segment, that one of the biggest returns they get on their investment is on weaned calves, calves that have been weaned for 45 days and are bunk broke, water or broke, and ready to go at the feedlot level. Then as you stair step up from that, you have the certified vaccination programs, the VAC 34s, the VAC 24s, the VAC 45s. And it's very important. We oftentimes talk about preconditioned calves, but it's important to separate out those multiple components of those systems. Then as you work your way up, obviously the natural programs, and then what we just term premium programs, those branded programs, whether it's cattle that have known performance for certified Angus beef or out of specific genetics for a particular program from a branded beef standpoint that allows somebody to have an indication of how well these cattle will perform in the feedlot. Agent source verified obviously was a premium that was out there significantly as Japan had their age requirements on U.S. beef exports. We still include it in here because we still believe that there is some intrinsic benefit to those programs, either as a signal to buyers of potential quality in those cattle, but also even just alone from a records-keeping standpoint, and from the standpoint of if any of these markets do reinstate an age requirement, it allows the producer instant access without having to completely re-implement a program on his ranch. And then lastly, and the most difficult for a lot of cow-calf producers to obtain is true performance data, actual feedlot and carcass data, on the cattle. And so keeping these things in mind, and the more of these things you can implement on your ranch and the better you can get at implementing them, obviously leaves you open to more of those premiums that are being paid on the back end for those cattle as they work their way through the value chain. And so those are some of the long-term considerations that I think all of us need to be aware of in our own operations. Next, I want to focus on points 2, 3, and 4 here. We just talked about some of the steps it takes to become a high-return producer. I think it's important now to focus on some of these other discussion items that can change and be adaptable even throughout a particular market year to take advantage of what the market's handing you. And that involves developing a marketing plan, knowing exactly when you want to sell cattle or what time of year you're going to make up your mind as to whether you're going to sell them as calves or feeder cattle or retain ownership all the way through the feedlot, and know exactly when you want to make those decisions to take advantage of market opportunities. I think point 3 goes hand in hand with that, understanding where retained ownership plays into your advantages as a cow-calf guy. With the high calf prices we've seen the last few years, that hasn't been nearly as attractive of an opportunity for a number of producers. But that's not to say that things won't change, and being attuned to when those opportunities exist will be really important to you. And then lastly, building the risk management plan around your marketing strategy. Understanding what you can do not only from a calf sales standpoint, but also even from an input management standpoint. When's the right time to be buying hay, buying corn if needed, utilizing and getting out and forward contracting crop residue to graze corn stalks or grain sorghum stalks or other forage sources that are available to you in your region, and making sure that you're doing those in a timely manner so that you're timing the seasonals of the market right and locking in favorable margins on your production segments. And so one of the things that's always important as you think about the idea of your marketing plan is understanding what market you're working towards. And as you look at this, I think it's important to recognize over the last 20 years, the calf market has been fairly consistent. We put in highs in the spring with that blue line there at the top, right there about 104 on an index basis, and we grind our way lower as we get more calves coming to market in the fall. Now what's also important though is if you decide at this point in time in October that you're going to market those cattle later into the winter or early spring as feeder cattle, then all of a sudden your marketing plan has changed. And what you can see is that basically from October all the way through January to March of the following year, the market doesn't have a whole lot of momentum to it one way or the other. And you really have to get into a period where you're clear out into April or May to take advantage of any serious opportunities to see prices increase. And that's a potential risk to you in the marketplace. And so one opportunity you might have if you're talking about marketing calves is instead of selling in this October time frame, try to start making up your mind as to what you want to do with those calves at about the point you turn them to pasture. And I mention that for 2 main reasons. One is it gives you an opportunity to forward contract those calves at a time of year where there's a lot of momentum in the deferred market that they would sell in eventually as feeder cattle. And because of that momentum, year in, year out, we see a premium rewarded to those producers that market cattle early, whether it's through a video auction market or forward contract marketing mechanism, that market through this early to midsummer time period. Obviously, corn prices and other factors also always need considered, but that is one opportunity if you make up your mind how you're going to market those calves in early June. The other opportunity that it gives you, if you decide at this point that you're going to try to retain ownership in those calves, either as stocker or backgrounding operation or even feedlot, is it allows you to be attentive to opportunities to start hedging those cattle against the appropriate contracts, whether it's using an options strategy or a futures contract strategy to try and time the seasonal of this feeder cattle market and put yourself in a position to lock in favorable break-evens, at least in the paper, knowing that you still need to market those calves in a live market at a later time. It's also, though, important to recognize that just because we have a 20-year seasonal that looks one way, it might behave quite differently depending on the market dynamics taking place in a particular year. This is just taking the 750-pound steer price seasonal that was on the previous graph and breaking it out by decade. And you can see here that in the 1980s, the market looked considerably different than what it did in the 2000s. and then let alone in the 2000s compared to the market we've been dealing with over the last 3 years. And I think what's interesting, and since recent history is always the easiest to think through, when you look at the last 3-year history, this is the reason that backgrounding operators and stocker operators were able to take calves that they bought at 550 pounds in the September, October, November time frame and be able to profitably sell them all the way through the early winter months. And so the thing is, this seasonal is going to probably change now if we get into a more permanent cheap corn environment. And it'll be important for producers, especially if they're CattleFax members, to be in tune with their analysts here in the office to understand the exact intricacies of that market and try to take advantage of what the market's presenting them. To get to that exact point, here's the market implied cost of gain if you do choose to take those October weaned calves and go ahead and grow them through a mid-February time period. And what this is looking at is this is looking at all periods since 1993 all the way through 2012, and this is based on weaning year. So essentially 2012 would be as of October 2012. And you can see that on average over this entire time period, the market paid, outside of the high corn years, basically a break-even cost of gain of 55 cents a pound. So what does that mean? That basically means that if you can take those calves in October and put that gain up to 300 additional pounds on them over the course of those few months, under 55 cents a pound, you made money. If you didn't, you lost money. And what you can see here is during the high corn years, the last 4 years, and then 1996, the market rewarded you more. And so what is the market saying today now that we're obviously in a time period of relatively cheap corn compared to the last 4 years? Well, if you look at October or the March feeder cattle contract as it closed today, it was right there between $157 and $158 a hundredweight. If you use an example for like a Kansas or Central Plains 850-pound steer sold in mid-February against that contract, it's going to be priced around $6 back from whatever futures is trading at on that March contract at that time. Basically, that's about $1,285. If you look at your calf prices for this fall, we're talking about a $170 per hundredweight price for 550 weights. What that translates back to is if you can put cost of gain onto those calves, add 300 pounds on those calves at about 116, by hedging those cattle against that March feeder contract today, if you can put cost of gain on them at a dollar value less than that, you're likely at a point where you can make money again this year. So just a perspective to keep in mind. Obviously, run those numbers against your local prices. And feel free to call your CattleFax analyst, and we can talk to you more about what those opportunities might be. Lastly, one more example. Mike touched on the value of retaining ownership in possibly your cows, your cull cows. And this is that example basically put into writing. And I won't spend a whole lot of time touching on this example, but similar to the last one, if you take that cow, and she's basically a canner grade cow in mid-September at 1,200 pounds, and grow her through the mid-February time period, basically adding a pound a day over 20 weeks, and sell her as an upgraded utility cow at 1,350 pounds, what is that opportunity? And you can see that corn until last year really didn't have a big effect on the market. Really last year was capturing more than anything a very robust market for grinding beef. But if you look at this today, if you can put that pound of weight on that cow for somewhere under 89 cents, more than likely you're doing it at a profit. And I know a lot of producers able to take advantage of corn stalks, grain sorghum stalks, old feed in some instances, although there's less of that today, can certainly beat that from a cost of gain standpoint and get a lot of value out of their cows. And so we've been seeing some questions coming in, and we're gonna dissect those here a little bit now. We're trying to get our screen to cooperate with us so we can see all of them. Just give us 1 second here, and we'll start touching on some of these questions. All right, now we're cooking here. We just had to get some room to see them all. One question we have here is, why do you think the economic signal is high enough to cause expansion? And we got Mike and Chad both right here in front of the mic, and so I'll let Mike handle that one.
Yeah, as we look at the value of calves as we've looked at the last couple of years, and if we start looking in here going into this next year, if we have cheaper feed costs, we feel like that the profitability of the cow-calf sector that's ranging between 100 to, in some cases, up to $200 per head is enough of an expansion or enough of a signal to go ahead and expand. Now, clearly, there's risk by that expansion, and that is that if Mother Nature doesn't cooperate, as you retain heifers or own cows, you're going to have to maybe go back to liquidate. So that's going to be the key thing that we have to look at as we go forward here, is whether or not Mother Nature is going to cooperate. It says, with higher price future forecast for feeder calves in 2014, what do you foresee the cow bred heifer value range for 2014 and following? And I think that's a great question. We tend to look at things from kind of an average perspective, and I think all of you understand that as we've looked in the last 10 years, you've seen a lot of separation in terms of the value of bred females. As we look at, though, for 2014, we think we'll spend a lot of time trading these bred females somewhere between $1,400 and $1,900 a head would be a solid number. And if Mother Nature cooperates, we'll spend a lot more time at the top end of the range. Kind of the old rule of thumb that a lot of people have used is that, the 1.5 to 2 times the value of calves. So if you've got calves bringing, $800 to $1,000 a head, that gets you kind of into that targeted level. So again, if Mother Nature cooperates, we should see bred cows trade in the the mid to upper teens there in terms of hundreds, I should say, for next year.
One question that we've had is, especially in the summer video sales, the spread between weaned and non-weaned calves appears not to be as robust as it has been in past years. One thing I'll mention to that extent is, as you look at those values, it's really difficult over time to assess basically what each specific management practice is yielding to calf prices. And I think what we've seen in the last few years is, one, I think our producer base has gradually captured and recognized that there's more value just in the base price of the calves that they're seeing, and so they haven't invested as much time in the weaning practice for se, but they still have very quality genetics. They still have a lot of the other, as we would say, bells and whistles in the marketplace. I think because of that, in the past, the non-weaned calf was kind of the mismanaged calf to a certain extent, that it was the varying in wide ranges of weight range across top to bottom in the lot, a lot of varying in genetics and management altogether. What we've seen over the last 5 or 6 years, I think, one, producers have gotten a lot better about managing their cow herd, and so the variation in weight and size and management has really been honed in, especially as we've culled more cows. I think the other side of it too is, because of the higher prices, fewer producers have been willing to go that extra step and be willing to go as far as to wean those calves. Because of that, it has the appearance that the spread for just simply weaning is narrowed. But in actuality, I think what you're seeing is a lot of the unweaned calves in the population today actually being pretty premium calves, with just the exception of not being weaned, that they've had their vaccinations, that they've been castrated, that they've been dehorned and had all the other things done right. The producer just simply didn't want to go that extra step to wean them for 30 to 45 days. And so I think that's one of the biggest things. I think the other side of it too is, when you look at the data from our perspective, weaning still carries a pretty significant premium for those lighter weight calves, but it doesn't take too many pounds beyond 600 to start seeing those premiums really narrow up. And I think a lot of that is because producers are willing to take on that added risk this year because they got some extra feed laying around, and because of cheaper corn prices, that once they get up to that upper 5s, low 6s, they're willing to take the risk on those calves being a little more mature and take the time with them needed to wean them a little bit themselves and start them out a little bit slower than they typically would. to take advantage and keep a few more dollars probably in their pocket than they normally would in a typical market.
Here's a question for Chad. It says, what is your outlook for hay supplies this winter and going into next spring and summer?
As far as the hay supplies go here looking forward, I think we're still catching up after last year's drought, the significant decline in production, and the excessive usage as a result of the drought drew stocks significantly lower. However, as we come through the summer of 2013, from native grass hay, from that perspective, we should have a significant increase in supplies coming through here, as well as significantly better yields and tonnage of alfalfa as well. But I think from the higher quality forage standpoint, it's going to take further on into the spring before we realize those cheaper prices, but we should begin to see those stocks improve significantly.
Well, we're about out of time. We just want to say, first of all, thanks for all of you that have registered and viewed the webinar. We appreciate your time to be with us. We appreciate Zoetis and their sponsorship for allowing us to do this. We do know that we had a little bit of a technical difficulty relative to the webinar. We weren't able to get as many people to view the webinar live as we thought we were going to, and we apologize for that. With that said, you've received an email from CattleFax stating that we will have the recorded version of the webinar available by 10 o'clock Central Time tomorrow morning, which is going to be Thursday morning. And then we're also going to go ahead and just put out in a PDF form. We'll actually put out the presentation in the PDF form out there on the CattleFax website as well. So you'll have access to that, because I know, again, things that those who were unable to view the slides, some of you were able to hear us but not view the slides, we're going to offer that up as well. So the next Trends Plus webinar that we have is scheduled for January 22nd, 2013. So please plan on that. We'll also be sending out an email with some questions, and we really, really would like to have your feedback on whether or not what you liked and what you didn't like about the webinar. And one of the key things in here as we look at this is just, did you see value in what we're trying to put together here? So we'll be sending that out for you. And just like with any survey, it's really about getting the response back from you so we can make the adjustments to make this better for the next one. And we're certainly going to work through the technology issues for the next one as well. So we appreciate your time, and everybody have a great evening.
Yeah, and we'll just make note, we've seen a few questions pop up. Yes, we do mean 2014. Sometimes us analysts aren't as good with dates as we are with other numbers. But and the other thing I'll mention in closing is we had a large number of folks that attended that were CattleFax members, but also had a portion of folks that were not CattleFax members. We encourage you, if you're not, to go to our website, and we're offering a membership promotion right now for our base level membership, which is a select membership. You pay the annual rate, and you'll actually get 2 years for the price of one. And so you can click on the banner that you would have seen right there on the question slide that's on our homepage as well, and become a member and be able to receive the other benefits that come with being a CattleFax member. We apologize for not getting to all the questions today, but feel free to send an email to the analysts that are there on that page, and we'd be happy to address your questions on a one-on-one basis. But appreciate you lending an hour of your time to us this evening.
Thank you. Have a good evening.